Welcome to today's lecture. Today's lecture is on national income accounting. We are looking at GDP estimation in this video. I show you how the GDP of every country is estimated, how the GDP of every country is estimated. Now, in this video, we are going to define GDP. We're going to look at the different aspects of GDP, different aspects of computation of GDP, and we're going to look at how that influences the economy and so on and so forth. So in this video, I'm going to look at some of these things related to GDP. Now, what is GDP to the average person? Once again, we are going to look at all these things in this video. My name is Gamel Abdel Nasser, lecturer consultant, Ghana Institute of Management and Public Administration, and I'm bringing you this lecture on national income accounting. Today's lecture, we're going to focus on GDP estimation. How to compute GDP is very critical because it gives us an idea of understanding what really the economy is part of national income accounting. And I mentioned in the previous video, it's related to macroeconomics. One of the goals of macroeconomics is to be able to estimate real growth. Okay, apart from understanding inflation and unemployment, we need to understand real growth or potential growth in the economy. Now, in GDP analysis, we're looking at what GDP is. So GDP is defined as the dollar value. It's defined as the dollar value of all final goods and services produced within the borders of the country. The dollar value of all goods and services or commodities produced within the borders of a country. So when we look at final value or the dollar value, we're looking at the monetary value of all these things produced by every country each year. So for example, if we are estimating the GDP of Ghana, we need to know the value of goods and services produced in Ghana every year. We need to look at the value of goods and services produced by Germany every year, produced by America, produced by China. All these kinds of things are added up to constitute a certain GDP number, and that gives us what the GDP number is. So in this video, I'm going to be looking at these kinds of things. Now, in the GDP estimation, we focus on final goods. Final goods are finished products. We don't focus on what is called intermediate goods. Intermediate goods are goods that are used in the creation of final goods. So we don't add up intermediate goods because we want to avoid the challenge of double counting in the economy. So to be able to make the estimation very efficient, we employ mathematicians and statisticians to do these kinds of analysis. Now, in Africa, for example, because we have high, statistical discrepancy, we tend to doubt some of these figures that our institutions churn out. If you listen to the news, you find a lot of people disagreeing with Bank of Ghana on some of these growth rates. For example, if we say unemployment rate is coming down, inflation is coming down, and then growth rate is going so high, and people are still feeling the hate in their pockets. So, for example, they tend to doubt some of these kinds of things, and it makes sense because in Africa and the developing parts of the world, because of the higher statistical discrepancies, we are not able to really compete these kinds of these things well. Now, if you compare that to America, United Kingdom, and other advanced parts of the world, you find that they have very low statistical discrepancies. So we tend to accept whatever they tell us. But here in Ghana, every time these figures come out, we tend to take it with a pinch of salt. In fact, a lot of people I disagree with, for example, Dr. Baumia, when he says a lot of things, and they say they don't trust him and all that. But it is not really his problem. It has to do with the statistical discrepancies here in the in the developing parts of the world. So with GDP computations, we are able to measure the real growth rate of every country every year. So that is what it does in GDP estimation. Now, in this video, we're going to look at two different aspects of the GDP. So the GDP is estimated either in nominal terms or in real terms. So you can estimate GDP in nominal terms or in real terms. Okay, so these are the two different sides of GDP estimation. Okay, now nominal GDP simply means that we are adding up the value of all things produced within the year using current prices. So when we say nominal means current prices. So you estimate value by multiplying the price of the item times quantity of the item produced. Okay. When we look at nominal GDP, we're calculating real outgrowth real output or growth in terms of prices in the current year. So we are using 2021 prices in the estimation of production or real output in the economy. So, but when we talk about real GDP estimation, in the real GDP, we don't use the current prices. We use what is called the base prices. Okay, we use the base prices in the competition. So that's the difference. So the nominal GDP tends to be bigger than the real GDP. Okay, because of these some of these inflated nature of these prices. Okay, so in the nominal GDP estimation, we use prices in the current year, that is 2021, and not any other year. So these are the two different ways of estimating GDP. Now, GDP is basically value of goods and services produced within the borders of a country each year. Okay, and you measure value in economics by multiplying price times quantity of items sold for every final product. Okay, so you do that for all these kinds of things, and once you do that, you aggregate these kinds of things. So it's GDP estimation is basically an aggregation. Okay, it's an aggregation of the value of all these products within the borders of a country. So when you aggregate production from all these kinds of sectors, that constitutes the GDP. Now, GDP is also related to an aggregation of consumption spending, aggregation of investment spending, aggregation of government spending, as well as what is called the net exports. So when we are actually accounting for GDP, the best way to calculate GDP is to add up consumption plus investment plus government spending, as well as the spending, as well as what is called foreign country spending. And then when you look at the two, it constitutes net export. So when you add all these things up, it constitutes the GDP value for every year of a country. So you can look at all these kinds of things. Now, consumption spending and then government spending and then as well as foreign spending are all related to all the four major economic agents in the circular flow theory. So we're looking at consumption by household agents, consumption by business firms. We're looking at consumption and spending by government as well as foreign countries. So when you add all these four economic agents, that gives you the GDP of every country. So there are three ways of measuring GDP or estimating GDP. There is the income approach, there's also the expenditure approach, and there's also the value added approach. Okay, the value added approach. So there are basically three major methods of estimating GDP. So the first one is the expenditure approach. With the expenditure approach, that was what I gave you. That is, we basically add or aggregate the sum of all expenditure, okay, in the economy. So we aggregate expenditure by households, expenditure by businesses, expenditure by government, expenditure by foreign countries, and that gives us basically the GDP number. And the GDP is an aggregation of total expenditure from all these four different agents within the economy, and that gives us the GDP number. And that is how you calculate GDP using the expenditure approach. So we are summing, or we are actually aggregating expenditure within the economy, expenditure from all the various actors within the economy, and that constitutes GDP, and that is the expenditure approach. Okay, so for example, government keeps spending money because government is tasked with the responsibility of providing public goods, providing roads, providing technology, and all these kinds of things. So government spends money, as well as spending money on defense to be able to protect citizens and so on. So government spends a lot because government has a responsibility of providing public goods to citizenry. So government spends. Now, businesses also spend a lot because they need to reinvest capital borrowed to be able to create more profits and to be able to become effective in the in the environment. So businesses keep investing more money in order to be able to become efficient in an economy. So businesses keep investing, and these kinds of things are critical to the development of the private sector in every local economy. Now, with the consumption, of course, the average human being, you and myself, would consume goods and services. When you are paid your salary, basically you spend a lot on consumption spending. You buy rice and send a little money to your grandmother in the village, mobile money that we are now going to tax. Interesting. So these are some of the things that we will be looking at. So when you look at GDP estimation, it's all about an aggregation of all these kinds of spendings within the economy, and that is the expenditure approach. Now, With the second approach to estimation of GDP, we're looking at the income approach. So with the income approach, we're looking at another level of analysis of GDP. Here, we aggregate total earnings from all different sectors of the economy, So we are going to aggregate our individual earnings within the country. Okay, so we are going to add up wages, we are going to add up rents, we are going to add up interest rates and profits and dividends. And when you add all these from different sectors of the economy, that constitutes the GDP number using the income approach. The income approach is very interesting. It was one of the areas that I focused in my doctorate thesis, and this is a very interesting approach, and it's very critical to many people. Okay, so with the income approach, these are the kinds of things you aggregate these kinds of income earnings from different sectors of the economy, and that is what the income approach is. So basically, the income approach and the expenditure approach are just two sides of the coin. Okay, it's related. So the GDP number, when you use the expenditure approach, is supposed to match up the GDP number using the expenditure approach. So when you add up all the expenditure, it is equal to all the income earned. Okay, so for example, if you spent 1000 Ghana cedis, okay, within the year, okay, you would have to have earned that money from a certain source. Okay, so you'd have to have earned that money from a certain source, and that basically speaks to the what's it called, the income. So for example, if you bought a new car, new Toyota Highlander for the 70,000 Ghana cedis, okay, that's expenditure, of course. But with the income approach, you would have to explain the source of the money. Did you earn the money working? Do you rent an apartment? Did you make that money from profits? Did you do some investments and got the money to buy these kinds of things? So when you add up money spent and then sources of income, it basically constitutes the GDP of a nation. So whereas the expenditure looks at all the amounts of things, whereas the expenditure looks at things spent on, the income approach looks at sources of income. So that is basically the same thing. And when you add up the numbers, it should give you the same thing. Now, the third method for estimation of GDP, that is in national income accounting, is the value added method. The value added method, VAM. So with this method, we are aggregating the value along each step of the production channel. So along each what's it called, stage of production, we add up the value of goods and services along each stage of production. That is what is called value added product. So we don't add up just the income and the expenditure, but we are looking at the value of the production at every stage of the production process. Okay, at every stage of the production process. So we do this because it helps us to avoid double counting. In GDP estimation, not every item is included in GDP estimation. Certain items are not included in GDP estimation. For example, used goods and intermediate goods are not included in the estimation of GDP number of every country. Okay, they are not included because used goods, for example, are not produced goods. They actually they just change ownership, okay, from one hand to another, and so on and so forth. So these are the basic differences. So the GDP estimation is done by a certain institution for every country. So for example, in America, it is done by the Bureau of Economic Review. In America is done by the review, but in Ghana, for example, it is done by the Bank of Ghana. The Bank of Ghana is headed by Dr. Edison. Dr. Edison is working with one of my senior colleagues, Dr. Nino Ashon. So Nino Ashon was my senior colleague here in the economics department of the Ghana Institute of Management and Public Administration, where he taught public sector economics, and he was one of the people who initiated me into teaching economics. And I know he's doing a very good job there, trying to help the government sort out some of these high statistical discrepancies, because I've worked with the man and he's really very efficient. So in the estimating of GDP, accounting, some of these things are interesting. One of my greatest Professor Anaman, has also worked with the Bank of Ghana, and he's done a lot of publications in these areas, and I have looked at all these kinds of works, and these are some of these things. So this GDP estimation using either the income approach or the expenditure approach or the value added approach are very critical approaches in measuring the economy. So in macroeconomic theory, this is very critical for everybody. So I hope you enjoyed this lecture on estimation of GDP. All right. And then this is where we leave it. My name is Gamal Abdenaza, lecturer consultant, Ghana Institute of Management and Public Administration. And in the next videos, I'll be looking at this in details. All right, we'll look at problems and solutions and how to calculate or address some of these issues in details. Thank you for your time.